Greetings, everybody. Welcome to the Liberty Call. Today's Monday, December 5th, 2022. Have the weekly economic update for us today. We're going to go through the stock market numbers. Don't look very good, unfortunately. Lots of red on my screen. I'm going to talk about some oil. Prices are coming down, which if you've been watching my show on a regular basis, you know that my hypothesis is that we're not going to see a lot of relief as far as inflation until we get energy prices down. So once energy prices settle and get back to a state of normalcy, be nice if we were drilling oil here in the United States, but I don't see that happening under the current cartel running things. And some unexpected news, the U.S. services sector has still chugging along pretty good. So let's go ahead and let me stop here. If it's your first time watching the Liberty Call, please hit that subscribe button. It's probably along here somewhere down here along the bottom of the screen. Give me some thumbs up, some likes, some shares, some subscribes. I would greatly appreciate it. All right, well, let's go ahead and jump into the numbers that look like crap today. All right, the Dow Jones was down over almost 500 points or 1.4%, closed at 33,947. The S&P 500 down 1.79%, closed at 39,98. NASDAQ down almost 2% at 1.93% down, closed at 11,239. Small caps were down over 3%. The VIX jumped today 8.87%, back up over 20, which anytime, the way I look at the VIX gauge is anytime it's over 20, that's kind of your yellow light when you're approaching the intersection. If it's over 30, that's your red light. Proceed with extreme caution. So we had dipped back below 20 on Friday, but it looks like it's headed back up with some more volatility. All right. Canada was down 1.19. Brazil was down 2.27. Mexico was down 0.84. Hopping across the Atlantic, Germany was down 0.56. The UK up 0.15. France down 0.67. The Euro stock's down 0.54. Netherlands down 0.54 also. Let's see here. Spain is flat at only down 7.8 points. Italy down 0.3. Switzerland basically flat for the day, down 0.03. And Portugal up 0.15. Let's see here. The Russian exchanges, where are they at? The MOEX the MOEX was up 1.28, the RTSI 0.64. Say bless you to my little man Jake back here, who's the watchdog on security patrol here at DSA Financial. Let's see here. In the Asian markets overnight, see mostly greens. Japan was up 0.15, Australia up 0.33. The New Zealand market's already open. In China, the Shanghai up 1.76, the SESE component up 0.92, China A50 up 2%, DJ Shanghai up 1.7, the Hang Seng up 4.51%. Boy, that's a big jump. And the Taiwan weighted was basically flat at up 0.07 for the day. So looks like the European markets and here domestically took it on the chin, while the Asian markets overnight did fairly well. So again, not surprising. All righty, well, let's go ahead and read through this week's weekly economic update. Week on Wall Street, stocks ended higher last week as investors navigated the cross currents of a potential easing and future rate hikes and continued strength in the labor market. The Dow Jones Industrial Average edged 0.24 higher. S&P 500 gained 1.13. NASDAQ was up 2.09. And internationals were up 1.68. A choppy week. The week started lower on concerns about protests in China over its zero COVID policy and comments by two Fed presidents that the Fed may continue its aggressive rate hike policy. Stocks then surged on Wednesday following remarks by Fed Chair Powell, confirming the central bank's intention to slow the pace of interest rate increases, which may begin as early as this month. Again, don't hold your breath. They may do a 50 basis point, but I don't think they're going to slow down to like quarter points in the next year. Personally, inflation just hasn't slowed down enough, but that's my own personal view. So, take it for what it's worth. Stocks buckled in early trading on Friday's monthly employment report, which showed higher than expected increase in new job growth and above expectations jump in wage growth, but stocks cut their losses by the end of the session to lock in a positive week. Labor may be a key. In a presentation to the Brookings Institute, Powell said that it might be time to begin moderating the pace of rate hikes. He cited several areas of progress in the inflation fight, including a deceleration in interest rate sensitive parts of the economy, such as housing and supply chain improvement. He also noted the price decline seen in goods and rents. But Powell suggested the labor market would need to cool down before the Fed could feel confident about making sustainable progress towards its 2% inflation target. November's employment report showed robust job and wage growth, which indicated any cooling remained in the future. All right. Economic data coming out this week. On Monday, we have the Purchasing Managers Index Composite, factory orders, and the ISM Services Index. Thursday, we have jobless claims and the Purchasing Managers Index of Manufacturing. Friday, we have the Producer Price Index and Consumer Sentiment. Just a handful of companies reporting earnings this week. On Tuesday, we have AutoZone and MongoDB. Wednesday, we have Campbell's Soup. Good. And Thursday, we have Broadcom, Costco, and Chewy, my dog's favorite store. All right. So again, some good things are happening. But again, I imagine that the downward trend we've been in for the last, 10 months is probably going to continue for a while because we haven't really seen a lot of capitulation in the market. Again, this is from a guy who's been doing this over 15 years and really pays attention to the broad picture as opposed to freaking out over every little bit of news that comes across my desk. All right, well, let's read through today's market recap, see what's happened here today. SP 500 slumps as stronger services data stokes hawkish Fed fears. Ooh, wouldn't want the Fed to continue to raise interest rates. I mean, how am I going to afford my new Porsche? All right, the SP 500 slump Monday as further data pointing to further signs of inflation pressures weighed on sentiment ahead of the Federal Reserve's meeting next week. Services activity, which has been an area of the economy flagged by the Fed as a key contributor to inflation, rose by more than expected in November, stoking fresh concerns about more hawkish Fed monetary policy measures. Again, these people freak out every time that the Fed is going to raise rates. ISM services data for November showed a jump to 56.5, well above expectations of 53.3, while prices paid index component of the report, a gauge of inflation, remains sticky at the very high level, end quote, Jeffrey said in a note. The Fed is expected to slow the pace of interest rates at its meeting next week, but recent data, including the red hot jobs report, on Friday shows that, quote, they are going to have to hold rates at a high level sufficiently restrictive for quite a while to get inflation back down to the 2% target, Jeffries added. Treasury yields rose as investors weighed up the prospect of higher for longer interest rates to bring down inflation, pressuring growth sectors of the market, including tech and consumer stocks. Tesla fell 5% as the electric vehicle company has reportedly set out to cut production of its Model Y vehicle by more than 20% at its Gigafactory in Shanghai. VF Corporation also dragged consumer stocks lower after tumbling more than 8% after it warned on profit for the second half of the year and announced that its chief executive was departing. Bye-bye. Energy led the decline, falling more than 3%, driven by a plunge in oil prices, even as OPEC and its allies, known as OPEC Plus, kept production plans unchanged and amid reports that China eased COVID restrictions over the weekend. EQT, Corporation, Halliburton, and Marathon Petroleum led the losses in the energy sector. Despite the weaker start to the week for stocks, some on Wall Street believe that the broader market may have bottomed and are likely to continue to search for direction in the months ahead. Quote, overall, the market is, Quote, overall, the markets are in basing bottoming mode heading into 2023, although we believe that the lows are either close or have already been established, the October levels, end quote, Janie Montgomery Scott said in a note. Again, these people are in such a rush to call the bottom that, it doesn't feel like the bottom of 2008 and 9. It doesn't, not that we really felt the bottom in 2020 because the Fed and the government came to the rescue with $5 to $6 trillion and really, bailed out the economy out of the bear market that we were headed into. Personally, I have to wonder if the whole achoo, sneezy stuff was just an excuse to print a lot of money. But again, I'm a jaded person and that's just how I view things. I'm very contrarian in my view on life. All right, next up, oil falls over 3% after data raises Fed interest rate worries. Oil prices fell over 3% on Monday following U.S. stock markets lower after U.S. services sector data raised worries that the Federal Reserve could continue its aggressive policy tightening path. Brent crude futures settled down $2.89 or 3.4% at $82.68 a barrel. WTI fell $3.05 or 3.8% to $76.93 a barrel. Both benchmarks had earlier risen more than $2 before reversing direction. During the session, WTI's front month contract began trading lower than prices in half a year, a market structure called contango, which implies oversupply. U.S. services industry activity unexpectedly picked up in November, with employment rebounding, offering more evidence of underlying momentum in the economy as it braces for an anticipated recession next year. The news caused oil and stock markets to pair gains. The data challenges hopes that the Fed might slow the pace and intensity of its rate hikes amid recent signs of ebbing inflation. Quote, macroeconomic jitters about the Fed and what they're going to do on interest rates are taking over the market, end quote. Phil Flynn, an analyst at Price Futures Group. Supporting the market earlier, the OPEC and OPEC Plus agreed on Sunday to stick to their October plan to cut output by 2 million barrels per day from November through 2023. So that's not going to help if we need more oil to drive our cars and energize our houses. But hey, I'm sure the Saudis know what they're doing. Yeah, keeping prices high makes them money. Quote, the decision is not a surprise given the uncertainty in the market over the impact of the December 5th EU-Russia crude oil import ban and the G7 price cap, end quote, said Anne Louise Hitley, vice president of consultancy at Wood Mackenzie. Quote, in addition, the producers group faces downside risk from the potential for weakening global economic growth and China's zero COVID policy, end quote. I don't know. I think China's probably going to slow down quite a bit on their, welding people into their buildings. The populace there didn't react too well the last time. And, pay attention, people here in Washington, that could be the next. People might come after you next. All right. Let's see here. The group of 7 G7 countries and Australia last week agreed on a $60 a barrel price cap on seaborne Russian oil. However, the price cap's effect on the futures market during Monday's session ran out of steam by the end of the day, said Andrew Lipow, president of Lipow Oil Associates. Quote, the market has realized that the EU is already banning the purchase of Russian oil with a few limited exceptions, and China and India are going to continue and purchase Russian crude oil. So the impact of the price cap will be mitigated, end quote, Lipow said. At the same time, in a positive sign for fuel demand in the world's top oil importer, more Chinese cities eased COVID curbs over the weekend. Business and manufacturing activity in China, the world's second largest economy, have been hit this year by strict measures to curb the spread of the coronavirus. It's a very deadly disease. It kills the elderly and the really fat people. Well, we could use less fat people, quite honestly. All right. And then last up, told you we were going to talk about the services sector. U.S. services sector activity unexpectedly accelerates in November. Boy, we hate those unexpected things. Growth in the U.S. services industry unexpectedly accelerated in November, overcoming a dip in new orders and pressures from elevated prices, according to new data from the ISM on Monday. The ISM said its non-manufacturing purchasing managers index increased to 56.5 during the month, up from 54.4 in October. Economists had predicted the reading would fall to 53.3. Boy, these economists and prognosticators are usually wrong. So if you were in the betting market, you probably go opposite whatever they have to say. A mark above 50 generally indicates an expansion. The uptick in activity brings an end to a 2-month string of slowing growth in the services sector, which makes up more than 2/3 of the U.S. economy. ISM's readings of new orders received by these businesses dipped to 56 from 56.5 in the previous month, but remains well within the expansion territory, with companies saying they are adding fresh customers and ramping up projects. New export orders contracted for a second straight month, but were offset by a jump in imports. The survey's measure of services industry supplier deliveries moved up to 53.8 in November, well above the 50 points to a slowing in deliveries, which the ISM says is typical as customers' demand rises. The backlog of orders edged slightly lower as well. Meanwhile, ISM's gauge of prices paid in the services sector retreated marginally to 70 from 70.7 in October, but is still relatively high levels. The figures come after ISM's survey of manufacturing sector activity in November dropped into contraction territory for the first time since the early days of COVID-19 pandemic. Prices paid by these firms for raw materials also decreased for the second time in nearly 2.5 years, and they continue to sign that inflation may be shifting from goods into services. The Federal Reserve has been raising interest rates aggressively in a bid to temper demand and quell a recent surge in price growth. But the U.S. Central Bank's Chair Jerome Powell has said that, quote, the time for moderating the pace of rate increases may come as soon as the December meeting, end quote, referring to an upcoming gathering of policymakers on December 13th and 14th. All right. Again, I will be surprised. I won't be surprised if they do a 50 basis point hike, but I certainly wouldn't think it'd be any lower than that. And with, looking at the big picture, all the data and everything that's going on, inflation is still really high. I would, if they did another 75 basis points at the meeting next week, again, that wouldn't shock me either. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. If you want to book a meeting, get your finances back on track, plan for retirement, plan to get those kids in college, or I don't know why you'd want to send your kids to college. It's a big woke fest. But if you still are dead set on sending your kids to college, we can still plan for that. Whatever you might need out there, I can probably help you with. And if I can't, I know people who can. So, all right. Well, hope everyone has a good night, and I will talk to you guys next time. Adios.